welcome back to the Women and Money Cafe podcast. This is us drawing to the close of our series on pensions, and we've saved maybe one of the most controversial topics till last, and that is, I've got a final salary pension. What can I do with it? And what prompted this episode is, I think I've mentioned before that I hang out in a lot of personal finance forums, and every so often you will see a post and it reads, I want to move my pension, but the providers told me I need a letter from a financial advisor, but I can't get anyone to do it. Or like they want to charge loads of money for it. Why can't they just do the letter? And this is all about trying to transfer a final salary pension. And I get that from your point of view, you've got this pension and you look at one of the numbers on the paperwork and the number might look really big and really appealing to you. And you're like, oh yeah, let me get at that. And you try and move it, and the company that's running the pension says, no, you need a financial advisor. You go and find one of us, and we seem like the most unhelpful people in the world ever, because the first 8 of us that you speak to go, no, we won't do it. And then the last 2, they want to charge you what seems to you like a lot of money for a letter. Like, what the hell is that all about? So what Michelle and I are aiming to do in this episode is just talk you through what your options are with the final salary pension scheme, why those first 8 advisors seem really awkward, and why the last 2 seem to be charging you so much money. So, Michelle, thank God you're here because you are a pension expert.
It's nice to be here. And as you know, do love a pension.
Yeah, I'm starting to think that you like your pension more than your family and your husband and your kids. But yeah, hopefully they don't listen so they don't know. So does anything I've just said sort of, have you come across this situation that I was describing?
Many times. So I am an advisor who is qualified to do pension transfers from final salary schemes. Now, not all financial advisors are. So I think that's one thing to kind of get out there first. Some of us are, some of us aren't. And then even if you are qualified to do so, the firm that you work with have to hold special permissions to do that. And so where the firm I was at previously, I had those permissions. So I gave lots of advice in this area, whereas where I am now, we don't hold the permission. So I can give you generic advice, but I also can work with other advisors that can give that advice alongside me. But the thing is, with this letter, so I've had it in the past where lots of people will come to see me for a meeting and they say, but I just want you to sign this letter to move it. Now, the reason this letter exists in the first place is if you've got a final salary scheme, which has what they call a cash equivalent value of over £30,000, you are legally required to get independent financial advice. So they get this letter because that's what the pension scheme has sent them, and they tell them to go and see an independent financial advisor. Now, the reason that we don't just sign that letter is, one, there's lots of regulations that sit on the financial advisors that give this advice. And it's a very, very highly regulated area. And as you probably appreciate, Julie, far more so in recent years, it's become more and more regulated for us with rules that apply. And it means that if we sign that letter, we're taking the responsibility for saying it's the right thing to transfer that pension. And there can be many reasons why it's not the right thing to do. So we would have to do lots of background and data gathering and checking that it's right for you. So I think that's where we start. If we sign that letter, we're saying it's the right thing to do, but we have to prove that.
All right. So let's say what I want to do is help listeners understand why it does seem so difficult to do this. And I think it's just sharing a bit of information. So you've touched on there the fact that you as an advisor, if you sign the letter, you're carrying liability.
Yes.
And I think it would be helpful for listeners to understand just how goddamn big that liability can be, is if we just track back for a minute and explain how a final salary pension works. And then what would be good if, once you've done that, is if we could talk about this, the cash equivalent transfer value, which they'll also here refer to as a CETV, because it's quicker to say.
Definitely.
So just wind back for a second and talk us through, briefly how a final salary pension works And listeners, remember this is how it works. So you'll start to get an idea of the liability that Michelle carries.
So a final salary scheme can also be known as a defined benefit scheme. So you'll hear them referred to as DB or final salary. But what it is, it's a gold-plated pension in our world. So it means that your employer's scheme promises you a benefit at retirement based on your leaving salary and length of service with that employer. And that promise is dependent on the scheme that you're in having sufficient assets to pay you that benefit at all times. So that's the official definition. So you've worked for an employer for a number of years and you have then accrued salary based on your salary whilst you were there and the length of time you were there. So obviously the longer you're there, the higher the level of benefit you accrue. Now your benefit, you will probably get a statement each year and it may come back and say, based on your length of service, your salary, you have accrued a pension of £10,000 a year from age 60. Doesn't mean that much to you right now because you're just, you're carrying on with your working life and £10,000 a year, that doesn't seem a lot, equivalent to the state pension. However, these schemes also have, I don't know, they don't all do it, but a lot of them will provide you also with your CETV or the cash equivalent, which can look very different to that £10,000 a year. So that £10,000 a year, firstly, will be paid to you from age 60 for the rest of your life, and it will go up with inflation each year. So you pay no charges, there's no investment risk. It is what they will give you. So so that is the gold-plated guarantee. Now, the cash equivalent value is when they take that £10,000 a year and they revalue it up to your retirement age. So we're going to use age 60 as an example. And then they turn that into what they call a capital value, and they use various actuarial rates, annuity rates to do that, and it creates a capital sum. And then they do what they call discounting it back to today. So they kind of take it back down to today's money, and then you end up with a lump sum. So it's a very long-winded thing to do, and all schemes, this is something to be careful of, all schemes have their own actuarial factors. There is no set factors for everybody. So you can have £10,000 in 3 different schemes and they will all give you 3 different capital values. So say that you've got this £10,000 and they've told you the capital value of that is £250,000. That looks very different to the £10,000 a year.
Mm.
And that can be really appealing to people. And this is what then pushes people to say, can I move it? From my point of view, I'm going to look back at that and go, okay, they're going to offer you this, but actually how long is that going to last you in retirement? If you take that money and we put it into another pension scheme, which is going to be invested. So we've talked a lot during this pension series about the investments that they're in and that values will fluctuate and whether it's right for you. So we're going to move it over here. We're going to put it in there. We're going to invest it, but you're going to pay charges on that because it's now invested and looked after on your behalf. And you're going to take money to suit you in retirement. And that seems fabulous. It's flexible. But when it runs out, it's gone.
Right.
If you're with the final salary scheme, your £10,000 is going to last. It's going to appear every year, increased by inflation till you die. So there is the big difference. You've got one with guarantees and they're cast iron guarantees, and you've got one where it could run out if you spent all that money. It's gone.
Okay, so that was a really, really good sort of overview for us. So where it is, I've got guarantees and no risk.
Yes.
If I move it, I've got risk, but I've got flexibility.
Yes.
As it's like we see. So you might have seen some of your paperwork come in from some of the big pension schemes. The cynic in me, so something happened to one of my clients a while ago, and I was really cynical about this, is they got the normal pension statement from the final salary scheme. They don't normally put the cash equivalent transfer values on, but they started doing it. And the cynic in me thinks that they're trying to get people to move out of the scheme. And I think if we go back a couple of years ago, these cash equivalent transfer values started getting really, really big.
Yeah.
And I thought, but now they've started to come down and reduce. So I wondered, Michelle, could you just give a little bit of background on why the transfer values shot up so high and what are the factors that have started to make them come down a little bit more now?
So primarily it's interest rates. So, and what we call government bond or gilt yields. So it can get really quite technical, but they're really based upon that. So the money in a low interest rate environment and a low gilt yield, so government bond yields are in line generally with interest rates. That money, that capital value would have to work much harder to give you that income. So your cash equivalent value is much bigger. Now we've just gone through a period of a year of, interest rate rises and quite rapid interest rate rises. So we're seeing now cash equivalent values for these sort of firms dropping by 30, 40, 50%. That doesn't mean that the income you're going to get each year when you retire is any different. It's remained the same. It is purely based on those factors that they use, which are the gilt yield and interest rates. And that's what it's based on. It's very hard to kind of quantify that. You think a couple of years ago, it's double that amount. But it's just because the money's got to work much harder. So they have to give you more in order for it to last.
I think in some ways, does that kind of really demonstrate almost like upfront some of the risk you're facing? Because if we go back a couple of years ago, I've got the scheme that's from somebody £10,000 a year income. I maybe had a transfer value of maybe 400 or 500,000. And today, that transfer value could be maybe 200,000. And that's just because we've seen interest rates move. So even if you move it, you're still going to be subject to the risk of interest rate movements and what that might do to your investment. Then you've got market risk, then you've got inflation risk. So it's just a whole shed load of risk. We've seen that the volatility is introduced just to the transfer value. That's before we even touch it with an investment.
Definitely. And I think when companies issue the cash equivalent transfer values, you'll often find them on statements where they can be estimated, which means they can move quite rapidly. Then you can actually ask your pension scheme for a guaranteed CETV. Now you'll get that, but it will only be guaranteed for a window of 12 weeks. Now, the reason for that is if there's economic change in that time, they'll have to change their cash equivalent value to reflect that. So they give you a 12-week window. And again, this can reflect why some of the cost and of the advice for an independent financial advisor to give that to you, or just not signing that letter, because that's a lot of work to do in that 12 weeks. You actually have to, I would take away the client's information, look at it, then I have to test whether that cash equivalent transfer value would give you equivalent or better benefits in retirement. And I'd have to demonstrate that. And I'd have to demonstrate it to be on life expectancy. So all advice that I would give would be tested past age 100 as a standard. And that's factoring in the charges, the volatility of markets, my charges, all those things have to be taken into account and what that person wants in retirement. So the overriding thing is I'm comparing an apple with a banana. They're completely different. So the work that goes into that 12-week window is actually really short and very, very time constrained. Because once you get past that 12 weeks, so I had cases in the past where we would be coming up to that point and we have to have it in. And I know of 2-3 occasions we missed that deadline just because of things happening. We didn't have the right information. When that then goes in, it gets recalculated. So generally, most schemes, if it had moved by 10%, that value would move by 10%, they would come back to the pension member and say, it's dropped by over 10%. Do you still want to move it? Generally, if it had gone up, they don't do that. They will just do the transfer. But in today's circumstances, it's likely to have dropped.
Right.
So it's really key. And I think that shows why some of the liability is there, because that liability for that advice sits with that advisor for the rest of their life. There is no cut-off period for that liability.
All right, so let's just put this into context for people. Okay, so let's say that I come to you for advice on this and I'm giving up my £10,000 guarantee per year.
Yep.
And then it turns out that at some point in the future, that was a bad idea. So then I can come and say to you, you messed up. So then you're faced with the liability of the £10,000 a year I would have received for the rest of my life. Bear in mind that £10,000 going up by inflation each year. That's an awful lot of money it's going to cost to put me back in the position I would have been if I hadn't taken the advice. It's phenomenal, isn't it? The risk to an advisor. So I think you start to give a really good idea there of just the scale of the work that's involved, the time pressures that you're working under. So hopefully that's starting to give people an idea. Plus, like, not many advisors do this because we're not all allowed to. I'm not allowed to, right? But Michelle's allowed to for her sins. So you've got to find an advisor that can do it. It's then understanding the amount of work that's involved and the time pressures they're working under. So you start to get an idea of now why it's not going to be a £500 job to get this one done.
Yeah.
So I'm just wondering if you could sort of give us an idea of the reasons why it's you wouldn't do it, the reasons why you wouldn't be transferring the final salary pension. And then maybe tell us, are there some scenarios where you think, okay, it might make sense to move?
Yeah, I think, as you say, there's more reasons for not moving than moving.
Mm.
One being that you would, so the Financial Conduct Authority, our regulator, is somebody that has taken a very big interest in these because there's been because transfer values were so high, it became a very big, lots of clients wanted to move them and it became a very big business for many advisors. So they started introducing rules. Now, even before these rules were introduced, it was always generally known between advisors that if you were under the age of 50, it was never really a good idea to move them because too much can happen between you in your 40s and your retirement at, say, 60 or 65, which are often what the scheme ages are. So generally, most would not deal with anyone under the age of 50. And a lot will now only deal with people who are actually at retirement, unless there's other overriding reasons. You'd be at the point of retirement. So you would find most people would be between 55 and 65 for this advice, because then you've got less room for your circumstances to change. So under the age of 50, really not even worth looking at. You just keep a note of your values and you keep that on file. Also, if your final salary scheme is your only pension scheme or your biggest pension scheme, a lot of advisors will look at that and go, I can't take away that guaranteed income, because that's actually going to meet your core expenditure in retirement. So you could say you've got expenditure in your household of 15,000 a year and you've got a £10,000 a year guaranteed pension. Well, why would you not need that? Because that is needed to meet your needs.
Okay,
So
can I play devil's advocate here?
Yep.
AKA client. I am somebody that wants the letter signing, and you're explaining this reason to me why you can't advise it. I'm not going to come back to you and say, I'm not going to live that long. I just want the money now to enjoy it.
Yeah, I've heard that one an awful lot. And actually, evidence shows that we all live a lot longer than what we anticipate. There's always going to be scenarios where that's not the case, but generally we all live longer than what we think. So that is why the testing to beyond average life expectancy, so for me, that was always past age 100, was really important. And also just to sort of say that if you go to an advisor and they tell you not to move it, they carry exactly the same amount of liability as if they tell you to move it. Because if later on you decided that actually it should have been moved for whatever reason, and it's found that that is the case, it's exactly the same liability. So it's not a safe option to say, keep it. You carry as much liability either way.
Okay. All right. So I'm trying to think what else people think. I think it's not an unreasonable, it's an understandable thought for people to have. And that is, well, it's my money. Why can't I do what I want with it? Why do I need you to do this for me?
And I think my answer to that has always been, because if I can demonstrate to you the value that it will give you in retirement and what it will give you alongside any other pensions you may have. So if I have a client with a defined benefit pension and they've also got another pension which is invested and it's got flexibility, You've got the best of both worlds. So you've got a guaranteed income, which is going to come to you every month for your retirement for the rest of your life. And then you've also got this other pot, which gives you flexibility. So you have the flexibility there already. You don't need to move this one for that. If you've got someone with two final salary schemes, then there could be mileage in saying, actually, let's keep one and let's move another. You may also have some schemes allow what they call partial transfers. So you keep an element of guaranteed income and then you move the rest for flexibility. So there's so many different scenarios you can have that really there's only a couple of very overriding reasons why you would discount all of that and actually move it.
And I think it's one of those classic examples of present you very rarely makes good financial decisions for future you.
Yes.
But really, a final salary pension, it's all about keeping the lights on, isn't it?
Yeah,
It
definitely.
guarantees that the lights are staying on in retirement. All right, thanks for that. So we've kind of focused on the reasons why you wouldn't do it. Are there any scenarios then when you look at one of these cases, Michelle, and you think, okay, yeah, we do this one?
So one of the ones that springs to mind is obviously, as we were talking about a couple of years ago when transfer values were high. Sometimes you would get the transfer value and you would look at the client's circumstances and they do have other guaranteed sources of income. And you say, actually, what the company is offering you, because sometimes companies did enhance the transfer values, not in a massive way, but it showed that they wanted to probably offset some of their liability. So they would offer, multiples of income which were beyond what you would need. Then there was mileage. You'd still have to prove all the other facts, but that would give you the sort of what we would call the legs to let it run its course. The other scenario, which can be overriding, is ill health. So with these pensions, they are guaranteed, but if something happens to you, your spouse is likely to receive a pension of 50%, or about 2/3, 66.67%. So civil partner, spouse will receive that if you're married. If you're not married, schemes can have discretion and your partner may not get anything. And it's very much down to, we always just have a saying, it's called scheme rules rule.
Right.
So you could think one thing, but if the scheme rules dictate something else, then it has to go with that. And if you have children, there's generally only children's pensions up to 18 or up to 21 if in full-time education. So if you found out you were very ill and you may not have dependents, you may not have a spouse, you may not have a civil partner. So effectively, when you were to pass away, the pension scheme keeps that pension. Nobody else would benefit from it. So we've had a few cases in the past where someone has been terminally ill, and that's probably the one that triggers it the most, or very serious ill health. And they want to move it because they want their family to benefit from that pension, because they know that they may not last the 2-3 years to get it. So we have moved them on that basis, and that probably overrides most other factors.
Right.
But there is a really big caveat to that. Now, pensions are free of inheritance tax. Generally, if you've given your pension administrator, the discretion to give it to who you've asked them to give it to through your expression of wish, they're free of inheritance tax. If you move a pension to change the shape of the death benefits and you die within 2 years of that transfer happening, it can be added to your estate for inheritance tax purposes.
That's quite helpful to know, because sometimes the sums involved tend to be quite sizable, don't they?
Yeah. So in the cases that I did, alongside that, I had to do the inheritance tax calculations as to what that may mean if the individual was to die within that time. And unfortunately, she died 4 weeks after the transfer. But we did get the money out. And yes, whilst it was subject to inheritance tax, the family managed to retain 60% of something that they would have had nothing of after paying 40% inheritance tax. That was how it actually played out in practice with all her other assets, but that is how we played it. And that is what she was happy with, because she had no children, she had no spouse, no civil partner. So she wanted her family to benefit from it.
Right, so the pension would have died with her if you had
Effectively,
that.
yes.
Yeah.
Yeah.
All right. So what I'm hearing you say there then is like there's two potential scenarios where a transfer might be viable. And the first one is if you've been offered what we call an enhanced transfer value, which is when the scheme is trying to reduce its liabilities. So they're encouraging you to walk away from the scheme.
Yeah.
So that might be a possibility. And then the second one is when we've got these serious ill health concerns and we're running the risk that the pension is going to die with the member or the benefits will be seriously reduced. So, but that one sounds like it's a lot more nuanced, trying to figure out whether that's the right one to do.
Yeah, definitely. And I also think you can get to a point. So when someone is at retirement, which is when ideally the advice is given, sometimes they want what we call the shape of their retirement to look different. So under a final salary scheme, you'll be given usually a tax-free lump sum or the option of having that, plus your guaranteed income of £10,000 a year. You may have a lump sum of £100,000 alongside that. Sometimes people want it to look different. So they don't want to take such a big lump sum, or they want to play with, the incomes they take. They want it to be variable. They don't want it to be fixed. Now, there can be some reasoning for saying you can change the shape of the retirement by moving it, and then you can bring in annuities, which I think we've covered in past shows, but where you buy another guaranteed income for life, but in a different form with maybe 100% spouse or civil partner protection. So there are ways of doing it, but that does become sort of more complicated, and you've got to know the client's circumstances inside out. And just to say, for any advice that's given in final salary, your financial advisor will want to know absolutely everything about you, your circumstances, your immediate family. And often they will want the spouse or civil partner involved in the process, because effectively they're also giving up their spousal or civil partner rights in the event of your death.
All right. Now, I think that's a really good point, actually. The advisor is going to want to know you and your family's lives inside out.
Yeah.
There's another reason why it's costly and it's time consuming as advice. And that's just because the repercussions of the advice are so far reaching, aren't they?
Oh, yeah. And you're giving up such a big guarantee, so it has to be the right thing to do.
Yeah, and it can't be undone.
No. Once that transfer has happened, there is no going back. The pension scheme won't take it back. And if you run out, the pension scheme won't give you more. That is it. So, I think it's just care has to be taken, and the current economic circumstances have just made that even more difficult, I think, and more challenging to show why it could be a good thing for you.
Yeah, and I think things by the time you actually come to, let's say you have done a transfer and the time you come to start receiving the benefits, you're in retirement, your capacity to generate more wealth has finished.
Yeah.
It's like we've reached the end of the game, and whatever you've got is what's got to last you until the end.
Mm-hmm.
So, all right, that has been really, really informative, Michelle. Is there anything else that you think we need to add?
No, I don't think there is. I think we've given quite a good overview, and I think if anyone has any questions, it is just about contacting us and asking.
Clarity, you want to contact Michelle? Because I'm not allowed to do this. So, Michelle, just for people that do have questions, what is the best way for them to reach out to you?
So probably for me, it's on Instagram. It's Michelle Lambell Money.
All right. So hit Michelle up with all your pension questions. So all your final salary questions. If you were listening to the previous episode, if you're the person with 10 pensions, then you'll remember that Michelle absolutely loves working with you. So do get in touch with her with that. So yeah, hopefully that's helped you understand, like, if the benefits are worth over £30,000, yes, it's the law. Unfortunately, you need to go and get a financial advisor. But hopefully now that you've got a little bit more understanding as to why they can't just sign the letter and why they do need to charge you significant amounts of money for the advice. It is there for your protection. And quite frankly, it's for our protection as well, because of the liability that it causes. Right. That hasn't been the most fun or bouncy episode ever, but it was necessary. And hopefully those of you that listened to it did actually need that information. So it just remains for me to say thank you, Michelle.
No, you're welcome.
Your expertise. And thank you for listening. But until next time, please take care of yourself.